This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to the latest episode of the Money and Markets podcast. I'm Laith Khalaf and joining me today is AJ Bell's Head of Policy, Tom Selby.
Hello, everyone. Now, while some of you may be winding down for the summer holidays, there's still a huge amount going on in financial markets and the world in general. We'll be talking about the FTSE 100 climbing above the 9,000 mark, the start of US earnings season, and Bitcoin setting a new record high.
We're also going to be diving into the latest inflation figures and running through the flurry of government announcements that we've had precipitated by the Chancellor's annual speech to the financial services sector.
That's right. And our guest this week is Lynda Shillaw, CEO of the Harworth Group, which is a property development company based in Yorkshire. She's been chatting to Danny Hewson about the company being promoted to the FTSE 250 and what government changes to planning policy mean for the property sector. But before we get to all that, let's talk markets, Laith. And there was a big breakthrough for the FTSE 100 this week, wasn't there, when it traded above 9,000 for the first time in its history?
Yeah, that's right. It was a very brief flotation above the 9,000 mark, lasted literally a couple of hours. And then that was on Tuesday morning and it fell back towards the kind of 950 level towards the end of the day. Nonetheless, a very significant moment, I think, for the FTSE 100 in the context of what's happened this year. It started the year at 8,260 or so. So it's risen by 9%, more if you include dividends in a little over 6 months. So a very good performance from the FTSE 100. It's actually beaten the S&P 500, the US index, which is up only 6% this year. So we're only halfway through the year, but still things are looking good for the UK blue chip market. And also, if you look in the kind of history, the context of the longer term returns from the FTSE 100, from 1999, when, the height of the dot-com boom, the market hit a peak of almost 7,000 at the end of December 1999. It took 15 years for the FTSE 100 to get back up there. That happened in 2015, 10 years ago. It's not been plain sailing since then by any stretch of the imagination for the FTSE 100, but investors have still had reasonable returns. So if you look over the last 10 years, since July 2015, when it hit that kind of 7,000-ish mark, the investors have had 7% a year, basically, from the FTSE 100, including dividends. Now, that sounds pretty pedestrian if you put it next to performance from the global stock market or the S&P 500 because of the performance of the Mag 7 mainly. But actually, it still equates to roughly a doubling of your money in 10 years, which I don't think is to be entirely sniffed at. And if we look at gains made this year, they've also been made in the face of a weakening dollar. And that actually provides a share price headwind for many of the international companies on the UK stock market because they have lots of dollar revenues. And also just looking across the more modestly sized companies, the FTSE 250 is still around 10% below its record level, which it reached in 2021, but actually seems to be making some progress too as well this year.
So a bit of good news there, and I think useful context as well for the discussion we're going to have later on Rachel Reeves' Mansion House speech and how she's trying to drive more money from cash into long-term investing. But first, let's look at the crypto market, and records have been broken in that market too. So with Bitcoin reaching a new record high. Plus, apparently, and I didn't know this until you sent me the script, it's crypto week. So what on earth is that for our listeners, but particularly for me, because I had no idea?
Yeah, well, I don't know what rock you've been hiding under, but it's the name that's been given to. But is there any room there? Because I'd like to join you. It's the name
there's room for one more.
There's room for one more. Yeah, hiding from the digital revolution. Yeah, it's basically the name that's been given to this week by the press, largely because there are a couple of important bills going through the US Congress. which are going to set the regulatory framework for digital assets in the US. And there's been a huge amount of lobbying by the crypto industry to try and get these things over the line. Some pretty crazy stuff going on, Tom. Coinbase, the crypto company, has set up some vending machines around the Capitol building in Washington. And these machines are giving away free chocolate bars, basically. And I don't know if they're thinking maybe, lawmakers are going to go into the Congress on a bit of a sugar high and, vote through all these bills or what. But it's a kind of sign of, how behind all these reforms the crypto industry is. And, the Bitcoin price has reacted accordingly. It's hit a high of $123,000. And if you look at the backdrop, I think there probably are some reasons why you could say there are reasons why the crypto bulls might be in a positive mood. We know that the US president is intent on boosting crypto markets. I think some of those of a moderately cynical bent have pointed to his burgeoning crypto empire as a possible reason why he might stay the course on that particular endeavor. But we've also, and this predates Donald Trump, we've also seen regulators in the US approve the launch of Bitcoin ETFs. And that is quite important. That widens the pool of prospective investors for crypto. And actually, it kind of feels like the investment case for Bitcoin might be shifting a bit, I think, from its potential to be a major currency of the future and maybe more towards the possibility that it becomes an alternative asset that might be used in portfolios, not unlike gold. So, obviously lots of risks still attached to Bitcoin. It also seems to me that the Bitcoin price is now actually quite heavily linked to the US political cycle because of, Donald Trump's agenda being very key to the price appreciation that we've seen. Of course, presidential terms last for 4 years. Who knows where Bitcoin will be in 4 years? That's a long time to make hay in Bitcoin, potentially. But also, just bear in mind that if the market starts to sense that the kind of Trump crypto party might be coming to an end, prices could start to adjust ahead of 2028. And I'm thinking, Tom, it's possible, who knows, but it's possible as early as next year. You've got the midterms coming up. If the Republican Party doesn't do well in those, you could start to see, power leaching away from Trump and potentially some impact on the crypto market as well. I think irrespective of what happens in US politics, as we know, Bitcoin is super volatile. And so there's a massive range of outcomes, extremely wide and unpredictable outcomes. So if you hold some, you might do extremely well, but don't be surprised if you end up with probably not enough to buy one of those chocolate bars, to be honest with you. So as I say, a wide range of potential outcomes.
Yeah, interesting. A lot of uncertainty in that market. I'm sure it's something we'll talk about again over the next 4 years, at least if that's how long Donald Trump lasts for. We've also started to see some earnings updates come through in the US, haven't we? So what's the vibe been so far?
I think the vibe has been a bit mixed, to be honest. We saw some positive numbers coming through from JP Morgan and Citigroup, particularly from their investment banking decisions, which have made a bit of money in all the volatility caused by tariffs. We did have quite an interesting trading update from BlackRock, actually, which saw the share price falling by 5%. So BlackRock said that its assets under management rose to a record high of $12.5 trillion. But the market was disappointed with inflows. And, that disappointing number has been largely attributed to one large institutional client in Asia pulling $52 billion out of BlackRock's index tracker products. And, that's a huge amount, isn't it? Obviously the market took a dislike to that. Probably does, highlight a little bit the risk that these big kind of passive asset managers are open to if big clients decide actually they're going to move away from passive or just move away from a particular asset class. BlackRock's kind of it does everything, but it's very well known for its fixed income. So potentially people coming out of fixed income might have an adverse effect on BlackRock. And elsewhere in the US market, Nvidia, it's a while until Nvidia reports, but we've seen shares rise to a new record. Last week, it became the first company to hit a stock market valuation of $4 trillion. So another big mark for Nvidia to hit. And, it's been boosted again this week by, the White House relaxing export controls on its chip sales to China. And that sent the price up again. I think that news also probably helping a bit more to reassure markets that tariffs might again not be as bad as expected. Though, I think in some corners it's fair to say that there is some suspicion that markets are being quite complacent about tariffs. We have also had, just on the usual kind of weekly tariff update, we have had news out from the US Treasury. Quite interesting there, showing that Trump's tariffs have actually raised almost $50 billion in tax revenues for the US. So, that's I guess a positive story on the face of it. But I guess the question is, where does that money come from? Is it coming from company profit margins? Is it starting to feed through into price rises for consumers, or maybe a bit of both?
And speaking of price rises, now I'm old enough to remember when inflation and interest rate news wasn't really news, but over the last kind of 5 years, every announcement from the ONS on inflation and Bank of England on interest rates has been waited for with bated breath and usually a bit of apprehension as well. So we've had some new inflation numbers, both here and across the pond in the US in the last few days. So is it good news or is it bad news, Laith, and what direction are they pointing in?
Well, I think it's pretty fair to say that it's the wrong direction in both cases. So if you look at the US, the CPI rate came in at 2.7% for June. That's up from 2.4% in May. And there are some sort of tentative signs that tariffs are starting to bump up consumer prices in the US. We did see US bond yields twitch higher on the back of those inflation numbers, which suggests that the market thinks that's slightly pushing back the case for interest rate cuts. It wasn't a huge move, but enough to say, well, actually the market thinks that this inflation reading was probably hotter than they were thinking it would be. And again, here in the UK, we've had an inflation number coming out this morning of 3.6%. For June. That was above expectations of 3.4%. The ONS said that was largely down to movements in transport costs, particularly motor fuels and airfares. Airfares, they said, normally go up in June because I guess there's a lot of demand. But June of this year saw the largest increase in airfares since 2018. So rising 7.9%. Compared to 3.2% rise in the month last year. So that clearly the inflation here is well above the Bank of England's target of 2%. But it's not that out of tune with what the bank has been expecting. The bank always expected inflation to rise this year and has been banging the kind of transitory drum again. It's not framed it as transitory because that word now is quite loaded after, in a cost of living crisis. A lot of the central banks were telling us that inflation was transitory. It turned out to be anything but. So the Bank of England's always been expecting inflation to go up. Interestingly, in the longer term, they expect inflation to fall back again, which is why this week we've also seen Andrew Bailey talking up the prospect for interest rate cuts. I think it's fair to say. And on the back of some weak economic data that we got in Q2, I think that there's a good reason why that might be the case. So we've got an interest rate decision coming up August 7th. That's the next one. For what it's worth, markets are pricing in around an 80% chance of a rate cut at that meeting. That would take base rate down to 4%. And then looking a bit further out, the expectation would be for one more cut of 0.25% before the end of the year. So that's just what the market's expecting. Not necessarily right, probably wrong, but gives you an idea what current expectations are baked in. So yeah. So let's move off kind of market movements to for a little while, because we had a big event last night. So we're recording this on Wednesday. So Tuesday night, the Chancellor gave her second Mansion House speech, which is an annual speech to city bigwigs. So quite a number of, I think, significant announcements made. So, Tom, should we just try and pick out the highlights? Let's start, please, with cash ISAs. There were fears that cash ISA allowance was going to be scaled back, but it looks like there's nothing from the Chancellor on that front. Does that mean that all of our cash ISAs are safe?
Yeah, my wig isn't big enough to get an invite to the Mansion House speech or the dinner, unfortunately.
That's work on for you, yeah.
Yeah, lots of rumour and speculation ahead of the Mansion House speech that the Chancellor was minded to reduce the cash ISA allowance. Now, it's important to say the Chancellor has never actually said specifically that's what she wants to do, but that was the story that was being briefed to the press, whether it was from certain parts of the industry or the Treasury or a bit of both, we don't know. What the government has said is that it wants to get the balance right between cash and long-term investing, and it has got a particular focus on the ISA market. Now, we know that there's huge amounts of money held in cash ISAs that could probably be working harder for people in terms of investing for the long term. So we reckon somewhere in the region of £100 billion, possibly more, held in cash ISAs by people who've got decent chunks of money in cash already, who haven't opened a stocks and shares ISA, and for whom investing for the long term in a stocks and shares ISA might be a better answer and might deliver better long term returns. So the question at the moment is, what reforms to ISAs, if any, could help redress that balance, and what exactly is the Chancellor going to do? Now, you started off by asking, are cash ISAs safe? I think we didn't get enough information to say that's the case. So the Chancellor said that they're still looking at reforms to the ISA market, but they haven't yet landed on exactly the best way to do that. So our research suggests that if you take a cut to the cash ISA allowance, actually that won't necessarily lead to more people investing, because unsurprisingly, lots of people who are comfortable with cash at the moment would just seek a cash alternative over and above whatever their allowance is. So NS&I bonds, for example, or just putting the money in a bank account and accepting that some of that money might be subject to tax. Now, if I can briefly get on my soapbox on this, that AJ Bell's view for a long time has been that rather than coming up with newfangled ideas, either to cut the cash ISA allowance or to introduce new types of ISA to get more people investing, the most straightforward way to sort this issue out is to move away from this slightly odd position that we have, where we define the two main ISA products by what you can invest in. So it's you either turn left for cash or you turn right for long-term investing. And actually, most financial planners will tell you that for most people, you want a bit of both. So you want cash for your rainy day pot. And then once you've built up a decent rainy day pot, you want to transition to long-term investing. But at the moment, the problem is that those two things are split. And so you create friction in the journey. And I think what we see is lots of people just going into cash and then sticking with cash because there's that extra hurdle to go through to open a stocks and shares ISA to invest for the long term. So I think there's a straightforward reform that the government could and should consider, which would involve combining those two main products to start with, so that rather than having a cash ISA and a stocks and shares ISA, you've got a single main ISA that allows you to invest in cash and allows you to invest in funds and stocks and shares for the long term. And then people can transition from the former to the latter much easier rather than having to open a new product. But unfortunately, we didn't get any clarity at all from the Mansion House speech. So I think it's going to be all eyes on the budget later this year, not just for some difficult tax decisions, but also for some clarity on exactly what the Chancellor wants to do with our ISAs, because it's clearly something that's really, really important to investors and stirs up quite a few emotions among people as well.
But those two things might not be entirely separate, because I think if she slashes the cash ISA allowance, that also has an impact on government revenues, doesn't it? Because it means that probably they're going to get bigger tax revenues, and perhaps that is, the moment that she's waiting to unveil that. So, I mean, alongside this whole question of the cash ISA, it does seem that the government has listened to a lot of the commentary that's, I think, been written about trying to get people to invest, and rather than just using a stick of taking away their cash ISA allowance, actually trying to kind of, perhaps provide a carrot and some encouragement. So it sounds that there's going to be an advertising campaign on the benefits of investing versus staying in cash, which I guess harks back to the Tell Sid campaign around the flotation of British gas back in the 1980s under the leadership of Margaret Thatcher. And from next April as well, the Chancellor has said that banks are going to be able to send messages to people holding cash in low interest accounts to be able to prompt them to move into investments. And the government reckons, moving £2,000 from these accounts that are paying 1% or less in interest to stocks and shares could make people over £9,000 better off in 20 years' time. And Tom, I assume that's part of the targeted support rules that are coming in that's allowing the banks to do that. Is that right?
Yeah, that's right. So the way that it was described by the government, I suspect to try to make it real to as many ordinary people as possible, was around banks and holding cash and moving into long-term investing. But actually targeted support is much, much broader than that, and potentially going to have much more impact as well. So it's not just banks, it's platforms like AJ Bell and others. Financial institutions across the market will be able to give people more useful nudges that don't count as regulated advice in order to help people make better decisions about their money. So that might be someone who's got a decent chunk held in cash at the moment and saying maybe long-term investing might be better for you. And based on some things we know about you, possibly from a questionnaire that you might have filled in as part of that journey, here's a fund that might work for you based on what you've told us. So a big, exciting potential reform that should help people who don't take regulated advice get better, more useful information. I think the challenge at the moment is that the guidance rule and the interpretation of what firms can say to people without crossing that advice guidance boundary isn't particularly clear. I think lots of firms tend to take a very safety first approach to that. And as a result, people are just getting quite generic information, still useful about how the rules work and the things they need to think about, but there's nothing for the kind of what next. So you get given that information, and then what should I do with my money after that? What's broadly going to be the best thing for me to do? So I think potentially good reforms that could really help people, but we still need to see the final rules and how that's going to work. And there's some certain things around marketing restrictions that need to be ironed out. But the Chancellor's been clear that she expects this to launch in April next year. So there's going to be a heck of a lot of work for the regulator and for the industry and others to do to get those reforms off the ground and helping people.
Yeah. Can I put my little cynical hat on here?
Go on.
For a moment. These reforms basically say that you can give targeted support to people. So all those things that you're talking about. So potentially banks are going to be able to tell people to move out of low interest accounts and into investments, for instance. But those low interest accounts are actually quite profitable for banks. And there's nothing forcing them to provide that support. As far as I'm aware, it's still kind of a voluntary thing whereby they think, if they think it's good for their customers, then maybe they will do it. Maybe they'll kind of say, well, it's not in our commercial interests, but we will try and, I guess improve outcomes for our customers. But I guess the cynical part of me just says, well, there's actually not a lot in it for the banking industry, and you can perhaps change the framework to say, well, you can do this, but there's nothing actually then, leading them to perhaps do that, unless maybe, I guess you could make a case that, the consumer duty reforms maybe force them into doing that as well. So that's I guess the kind of the framework that's coming next April. We also, I think, in the run up to this Mansion House speech, heard a lot about pensions, but I couldn't see anything in there. Tom, have I missed anything? Was there?
Yeah, when you've got me on the podcast, we have to talk about pensions at some point. It's in the contract.
It's one of your riders, yeah.
So yes, there was an expectation that the government was going to announce more details on the second phase of its pensions review. So it's done phase one of that review. That was very much focused on getting big workplace pension schemes and local government pension schemes to invest more in what they call productive assets, based primarily here in the UK. So that's things like private equity, trying to get more money into roads, rail, green energy projects, things that the government thinks will help drive long-term growth in the UK. And obviously that's something that for the best part of 20 years or more, governments have really struggled to achieve. So that was the first phase of the review, and we won't know probably for at least a decade whether that's delivered any good outcomes either for savers or the economy. But the second phase of the review, which I would argue is for savers more important, is looking at adequacy. So at the moment, we've got automatic enrolment into workplace pension schemes, but you only get 8% of a chunk of your earnings if you're enrolled at the minimum as a contribution. Most people agree that's not enough to deliver certainly a comfortable or even moderate standard of living in retirement. And the question is, to what extent is the government committed to trying to increase people's minimum levels of contributions? We've also got the self-employed who aren't covered by automatic enrolment at all. And actually a big crisis potentially coming down the line is going to be undersaving in that part of the market. You've got millions of people who are self-employed, and lots of those are saving nothing at all in a pension. But from the government's perspective, there's going to be a challenge here, because lots of people have suggested that the solution to the adequacy challenge in retirement is just to jack up contribution rates. So you move that minimum contribution rate from 8% of a chunk of earnings to, say, 12% of all of your earnings. Now, that sounds good in theory. The challenge there is you'll be taking money out of employers' pockets, presumably, in order to fund at least some of that extra contribution. And you'll be taking money out of employees' pockets as well. So there's two risks there. The first is that you load extra cost onto employers who have just had a £25 billion national insurance hit. And so that's not going to work with your growth agenda. And in terms of employees, well, if you take more money out of their pay packets, then there's a risk that they'll just give up and opt out altogether, because actually lots of people are still finding it pretty tough out there. So everyone's agreed on what the challenge is in terms of adequacy, but dealing with it, I think, over the next 5 years, unless we get some rapid growth from somewhere, if AI kicks in or something like that and the economy really starts to go gangbusters, I think it's going to be difficult for any government to do anything meaningful in that space. And I think that's why, rather than announcing changes, the government's doing an independent review, which allows you to build up an evidence base. But also, if I take your cynical hat and put it on my head, there's an argument that that's just kicking the can down the road and probably leaving some difficult decisions for the next government, whoever that may be.
Could you not just say increase it over, say, 5 years?
You
gradually?
Could, but again, we don't know what's going to happen to the economy over 5 years. And so if Rachel Reeves came in assuming or hoping that growth was going to bail her out of her various restrictions on tax policy, and that's clearly not happened. Now, if we do get growth, then I think scaling it over a few years might help. It would certainly help ease the pain. But employers, if you were to tell them your pension costs are going to go up over the next 5 years, I suspect many would react to that ahead of time and look to retrench in various different ways. So I think this is always the challenge with big retirement forms, particularly around auto enrolment, is they can't just be seen in isolation. Yes, we need to get more people saving for retirement, but it's particularly when you're layering on cost to employers, there is going to be this knock-on impact on the wider economy as well.
Yeah. Well, the good news is that she's fixed the public finances, Tom. So come the budget, there won't be any more fixing whatsoever required. I'm assured of that. So she also there were a lot of other meaningful changes that Rachel Reeves announced yesterday. So there are reforms to the Financial Ombudsman Service. The financial regulator is making it easier for companies to sell shares on the market by relaxing rules about their disclosures. And there's also been announced some quite significant bank reforms to reduce red tape, reduce capital requirements, and also reviewing the ring fencing between retail and investment banks, which I thought was quite interesting because that was a key protection that was brought in after the financial crisis. And we saw that those big runs on the banks as a result of on the retail banks as a result of what the investment banks had been doing. But there's also some stuff on the mortgage market, which I think it's maybe worth digging into a little bit more, because that probably affects quite a lot of people, or will affect quite a lot of people when it comes in. They're basically relaxing mortgage lending rules, which is going to be help to support banks provide mortgages for over 4.5 times a buyer's income. And they're also looking to create a permanent mortgage guarantee scheme. So the government essentially standing behind lenders and saying, we'll take some of the losses if you incur any on loan to value ratios of up to 95%. So what the idea of that is helping people buy a property with a smaller deposit, 5% of the property value. So yeah, all of that sounds pretty positive for the housing market. It sounds pretty positive for home buyers. I suppose it does, introduce a bit of risk back into the property and the banking system. If we look back 15 years, is it 17 years? Wow. The financial crisis stemmed in large part from irresponsible bank lending. And, Rachel Reeves has used this analogy, which I think is a good one, which is that the pendulum after the financial crisis swang back too far towards being risk averse. And I think I do agree with that. That's true. And I think what the Chancellor is doing here is pushing that pendulum away from being risk averse across the regulatory system. And, you look at everything that we've talked about, higher loan to value mortgages, people investing in stocks rather than cash, letting companies issue shares with fewer disclosures, relaxing rules for banks and for senior managers. All of that is basically saying we're going to take a little bit more risk. And I guess that's probably good for the economy. I guess the danger is that ultimately it goes too far back in the other direction. That's kind of what pendulums do, don't they? And I think probably history tells us is actually probably pretty difficult to get the balance right between risk and consumer protection.
Yeah, and I'm sure lots of people will have concerns at the idea of rolling back regulation and encouraging people to get cheap mortgages. I think you always have that period of time after something as significant as the great financial crash in 2007, 2008, where memories start to potentially fade about how bad that was and what those risks were. But equally, I think you're absolutely right that there is a balance to be struck here. And it's a question of, can Rachel Reeves get that pendulum right into equilibrium so it just stays still and we get growth in the economy while consumers are kept safe? But I guess we won't know the answer to that for a good few years yet. Now, we always love to get company bosses on the show. And this week, Danny Hewson has been chatting to Lynda Shillaw, the CEO of Yorkshire development company Harworth Group. Formed more than 20 years ago as the property arm of UK Coal, the company hit a significant milestone last year when it became part of the FTSE 250. Its inclusion followed a storming year for the company, during which profits more than doubled. And with the government's focus on simplifying planning and industrial strategy, the outlook is potentially for further growth. But there are still significant headwinds to battle, as there are for most businesses at the moment. And as Danny found out when she caught up with Lynda.
Lynda, thank you so much for agreeing to talk to us. Look, for those of people who maybe haven't come across Harworth Group before, just explain what it is, what it does.
So Harworth Group is a leading regeneration and strategic land and property developer. And we're focused primarily on industrial and logistics and the residential sectors. We've got a significant land bank covering around 15,000 acres of strategic land across more than 100 sites. And we are geographically mainly located in sites across the north of England and the Midlands. But ultimately, the focus of what we do is about creating sort of jobs and homes and communities.
And the reason for where you're geographically located is because the company was actually formed from the property arm of UK Coal, but an awful lot must have changed since then.
Oh, massive change. I mean, we relisted as Harworth, which is the property sort of side of what was left of UK Coal, in 2015, and I came on board in 2020. And so as we sit here today, less than half the portfolio is currently made up of those former UK coal sites. And one of our aims through our strategy is to maintain a land bank at around 12 to 15 years supply. So we acquire, and we've got specialist teams in the business that are focused on land assembly, sort of keep that hopper sort of fill. And we've seen really big changes in the focus of the business, particularly over the last 4 years, because historically the sites that we had were particularly skewed towards residential development and sales. But now that's more evenly balanced as some of these big industrial and logistics sites have come through planning. And we've also grown the portfolio significantly. So we've brought a lot more people on board into the business to support both our growth and also what we can deliver.
And last year, quite a milestone, because the company became a FTSE 250 listed company. That must have been quite a moment.
It was. We were really, I think, sort of quite surprised because we hadn't been tracking it. I know that's a terrible thing to say, but it wasn't in my KPIs. But we were absolutely thrilled, and I think it's a real testament to the dedication of the people. How hard they have sort of worked to deliver. Certainly over the last sort of 4.5 years, as I've been chief exec, and actually the strategy that we've put in place, they've embraced and they've got behind it. And I think it really sort of it's highlighted the commitment of the team to what we do. We all love what we do. We know actually what we do makes a difference in the regions that we operate in. A lot of the people who work in the business are local to a lot of those regions that we operate in. And that commitment and the consistency of delivery against the strategy is delivered both sustainable growth to the communities that, sort of we operate in, but to our shareholders. So we're all really proud of it. The business, the business sort of we're collectively, I think, both in awe but actually sort of really delighted by where we got to.
And I would imagine that then has brought you to the attention of more investors, particularly more retail investors, right?
Yeah, it has. And it's been really great to see. And especially if you think about it, our business model is based on long-term regeneration of sites, delivering into structural and supply sectors, but into communities. And the interest of both institutional investors and wealth managers has been peaked, and some have increased their positions since we entered the FTSE 250. But others are involved in active research. So we spend quite a lot of time with people who are currently not investors in the business. And just under 7% of our register today is now wealth managers, so like AJ Bell, and we'd love to see that increase. We've got a really stable cohort of long-term investors who've been with the business sort of since, some of them prior to it being relisted in 2015, and then some who've come in since. And they're really supportive of the strategy, of the long-term investment story, and the growth story that underpins that. And it's been interesting, as a small cap that's not been part of the FTSE 250 for that long. So we're coming up to a year on the 1st of September. That when we recently did some site tours, actually some of our Northwest sites, that when we take investors out to site, that they are consistently surprised by the breadth and the depth of the business and how important we are to the regional economies that we operate in. And also actually just the sheer scale of some of the regenerations that we undertake.
I know the business well, and I want to talk about AMP in Rotherham a bit later on. But let's focus a bit now on the business, because last year you had a couple of really big deals with some well-known names.
We did. Sort of last year we sold land capable of delivering 4.4 million square feet of industrial logistics space in 2 landmark transactions. So one was a £106 million sale to Microsoft at a site we call Skelton Grange on the edge of Leeds. It's the former power station. And then the second one was a £53.5 million pound sale of strategic land to Fraser Group, so the owners of Sports Direct, at a site that we call Amnesty in Rugby, with both transactions generating both significant value and profitability for the business. Now, it's probably important to stress that big deals like this don't happen overnight. They're many years in the making. But with a land bank at the size and the scale of the one that we have, we've got ample opportunity to repeat and replicate this sort of deal as we go into the future. And the team spend a lot of time looking for opportunities to really maximise, the value that we can deliver from that land.
And it's, as you said, a mix of logistics, industrial and residential.
Yeah.
There will be differences, but do they also complement each other?
They do. I mean, for me, what regeneration means, and thinking about the communities that I grew up in, it's about homes and jobs. It's not one without the other. If you create a load of jobs and there's nowhere for people to live nearby, it's really quite challenging for investors in businesses, to get the skill base that they need to be successful. But our roots and specialisms are operating in both large scale industrial and logistics and residential sites, and so from our perspective they do complement each other, because it fundamentally comes down to it all. Regeneration is about homes and jobs, and I would say especially in the regions that we operate in, where often former industry has been in decline or finished altogether, and it's actually it's about stimulating that next wave of industry to come in. And it's all about really how we bring these sites back to life and create something that's valuable to local communities. So there's a big piece of placemaking, whether it's an industrial and logistics development or a residential development. And we work really closely alongside the local authorities, the mayors and their teams, to bring also alongside our investment and investment by other businesses, the public sector investment that we need to sit alongside that, particularly into things like major off-site infrastructure. So, these are long-term, big strategic projects, not just for our business, but for all the key stakeholders that we work with.
And we've obviously heard a lot from the government over the last year, a focus on industrial strategy, things like planning simplification. Has that helped you and your business, or do we still need more to be done?
So I think, you got to start, the answer to this question is about 100,000 feet, because on the ground at the moment, I would say not a lot has changed, but that's for some really understandable reasons. But if you go to 100,000 feet, the policy direction is really supportive of our sector and the sectors that we operate in. So that sector being real estate, but specifically for Harworth, the delivering homes and jobs. And the ambition that this government have brought in around infrastructure investment and planning reform is really supportive to the agenda of businesses like us and what we do. And it's probably the most positive policy environment I can think, that I've worked in. I mean, certainly we've had the one most positive environment we've had for well over a decade. But I think when I look back, given the scale of reform that's actually going on, it's probably going to be one of the most conducive policy environments to stimulating investment, that I've worked in. But the challenge when you come down to the coalface, without using it as a pun, is that, the reforms take time to embed. They don't just happen because the legislation passes. And, what we're seeing on the ground is, there's still a lack of resource in planning teams, in local authorities. And of course, as the volume of applications starts to rise, which it should do in a positive policy environment over time, we simply don't have enough planners that can push through planning applications at the speed, that is probably necessary to get some real front end wins. And that's going to take some time to improve. Now, the government's also looking at how they do that as well. So it's not it's not something they're unaware of. And I think mayors and combined authorities are quite integral to some of this as well. I mean, whilst a lot of the mayors don't have planning powers, they're integral to basically bringing key stakeholders together, making sure that highways and rail and power and everyone who needs to be in the room is in the room, to provide a local policy environment and framework that that these applications can work through. So I would say it's a really positive backdrop, but it's likely to still be challenging for us, because we've always operated in this space, and we're successful at what we do, it's probably like, sort of no harder, sort of at the moment, or no easier than it always has been. But like I say, my view is that it will, as the reform starts to embed in local authorities, it will start to improve as we move forward through the next sort of few years.
So yeah, positive outlook, but clearly still a lot of headwinds. Last year, looked good. 2023 in particular was a tough one. And I would imagine some of the challenges that you were facing then, you're still facing increased labour costs, skill shortages, things that you need to consider.
Yeah, so our business performed sort of strongly operationally in both of those years, and a much stronger financial performance, as you said, in 24. And, the challenges, that we sort of were facing as we went through 23 and 24, to some extent are still there. I mean, you've got stuff that's happening in the macro, even in 25, like some of the things that we're seeing around tariffs, sort of wars in the Middle East, that means for the global economy, and the impact that has on the UK and that very tight fiscal position that the government finds itself in, and the unexpected rising business taxes in particular, that came out of that last sort of the autumn statement in October, means that when you're trying to stimulate economic growth and when you're trying to grow the business, you've got some real headwinds that you're facing into. I think thematically, sort of the sectors we operate in are still sort of positive. But I think, we've still sort of got some underlying cost inflation coming through. So if you think about construction costs as a whole are probably at a more normalized sort of trend of that 2 to 3%. But in there, and this is really sort of underpinned by the skills shortage, labour costs are still trending ahead of that. And we all know sort of our sector that once you light the blue touch paper, everybody runs, and actually activity will sort of really sort of go off hockey stick in terms of volume, and that will put pressure, potentially even more pressure on labour costs, because there is a insufficient sort of labour supply to deliver a market in a market that's going at full steam. So I think there really are still some challenges. The other side of that is there are some real positives as well, because when you look at what's going on in the macro, it means that businesses are rethinking about where they base their facilities or some of the decisions that they're making, which are the next 20 to 30 year investments. We're seeing supply chains onshoring. We're seeing, sort of activity even in the first half of this year is up across 3PLs and up across e-commerce. So we're starting to sort of see some shifts, and some of these will be investment decisions that businesses are making, like I said, for 20 to 30 years. What it does mean, though, I think the sort of quite tough environment that businesses generally are operating in at the moment is it's really elongating that decision-making process. And whilst we're continuing to have really positive conversations across a number of our sites with businesses, that elongated decision-making process is also meaning that what they're thinking about doing, sort of actually changes a number of times as we sort of go through that sort of time period. So there's quite a lot to contend with. It's a very volatile environment for people like me, to navigate businesses through. But we've been really consistent, certainly operationally, in what we've been delivering, and continuing to sort of drive through to that position where, sort of on average, we're looking at single high digit or low double digit returns as we work through the cycle. But it's tough at the moment.
I hate to ask you to do this, considering the huge amount of volatility, but let's just try and think 5, 10 years out. What's the goal? What are you most excited about for the business?
So, I mean, I've been here for nearly 5 years, and Harworth still hugely excites me. And it's the potential that sits in that land bank, which is the thing that gets me and all of my team out of bed. I mean, we can see it. We've worked out through what we've been doing over the last 4.5 years, how to unlock it, how to accelerate some of it, how to deepen our skill set in areas like data, for example, which, so that sort of Microsoft transaction has enabled. But what I'm really excited about is just continuing to build this business, making sure we're excellent at delivery in all we do, and that we're the go-to business for all of our stakeholders. So I've just touched on skills, and the importance of being able to attract skills in your business. I want us to have that that brand and reputation that says not only do investors want to invest in us because they trust us and they can see the consistency of delivery and that we're actually sort of driving forward against that strategy, but I also sort of want to be able to attract the best talent into my company because actually they think we're a great place to work. And from a supply chain perspective, they're also sort of core stakeholders to us. I mean, going back to a general skill shortage and some real structural changes that have been going on in the market, we want people to want to work with us and then to repeat, so that's massively important. So that building of our brand and reputation, delivering against what we said we were going to deliver against. So in 2021, we set out our ambition to grow our EPRA NDV to $1 billion by the end of 2027. And we're well on track to do that, despite sort of what we faced over the last sort of couple of years in terms of headwinds. But it's also important, I think, that we're continue to convey that message of the ambition for the company beyond that. And that's the strategy that we're working on. And if you think about it, sort of what you actually see in delivery in any year is like the tip of an iceberg, because underneath the water, we are continuing to assemble land and acquire sites. We're continuing to work sites through planning and start to invest in infrastructure. We've continued to grow that underlying pipeline. And actually, that's all about the sort of growth trajectory beyond 2027. So that's what really excites me. I think, the strategy is a great strategy. We're executing it well. And we know the levers that we need to pull now to sort of continue to drive the business forward and grow.
Lynda, thank you so much for talking with us.
Brilliant. Thank you very much. Thank you for your time.
Thanks again to Lynda Shillaw from the Harworth Group for coming on the show. Right, that's all we have time for this week. We hope you enjoyed listening. And if you have, don't forget to rate us wherever you get your podcasts. We'll be back next week with another episode. Till then, thank you very much for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.